Hi, everyone. I'm Rhonda Lemke. I'm a real estate agent from GK Properties in Las Vegas. For this episode, we have Tony Perry on from Novus Home Mortgage Company. A lot of people don't know where to start when they want to start searching for a home and they get kind of overwhelmed. They don't even know what they qualify for, right? This episode focuses on the first two steps, getting pre-qualified for a mortgage and then starting a search. We don't want it to be an overwhelming process and with spam emails and all kinds of paperwork. So we're just going to do one step at a time. And I want to point out, Tony, I really like to use expressions like, how do you eat an elephant? One bite at a time. So sometimes people look at buying a home as eating that elephant. So we're just going to start with the first bite today.
Sure.
So Tony, most people care about down payment and monthly payments, which kind of helps us guide them to the right price range, right, as a real estate agent. But let's start with getting pre-qualified for a mortgage. There are some preconceived ideas out there that you can't get a mortgage unless you have a large down payment, an 800 credit score. But I want you to walk us through the pre-qualification process and maybe even cover the soft credit check. Does that sound good?
Sounds great. So here's the biggest thing that I've ran into in my 28 years of doing this. The mortgage industry has just shifted dramatically from when I bought my first house in 1988 to now we're in 2025. When I bought my first house, and this is probably what some of the first time buyers are hearing from their parents is, oh my gosh, you have to have 20% down, because in 1988, you had to have 20 or 30% down. They didn't allow for some of these low down payments. So a lot of times the younger people will get some advice from older people that have not kept up with what Fannie Mae, Freddie Mac, FHA, and the government wants us to achieve home ownership. I want everybody to achieve home ownership because the only way you're going to gain true wealth is through home ownership. Yes, you can invest in stocks, and we'll go back and forth on that. That's fine. So I tried taking first-time buyers and saying, look, I have 3 children, 30, 31, and 36. They are all on their second home. The cost of waiting to say, all right, I'm going to buy a house. We can get into details on that further into this conversation, but my goal is to take every young person from graduated college to finding someone they want to partner with for the rest of their life, or at least try to partner with the rest of their life, and get them into a home, because paying rent, all you are doing is you are paying a mortgage, but you're paying it for someone else. People can really get into a house, a first-time buyer, with as low as 1% down. If you buy a $300,000 house, you need $3,000 or $4,000. First and last month's rent, Rhonda, out in Vegas, probably going to put $3,000 or $4,000 towards that. Would you agree?
Yes, 100%, 100%. Rents are around $2,000 to $3,000, depending on where you're at.
So with your guys' tax base out in Vegas, when I've done many loans out in Vegas, taxes are awesome. Oh my gosh, they are great out there.
Yep.
Because in Chicago, our tax base is just annihilated. I mean, people buy a $300,000 house, they get $10,000 a year in taxes. So when you're looking at a $300,000 house with a $3,000 tax bill, $300,000 sounds like, oh my gosh, that's a lot of money. I don't have $60,000 to put down, so I'm just going to keep renting. No, if you got $3,000 or $4,000 in a bank, you got a little 401k at your new job you got, we can help you. We can find a program, a down payment assistance program, something to get you going. And I want to go into a little more financial details, because I had to argue with my same kids that are 25 and 30 years old. Well, I'd rather put my money in the stock market. I'm like, great. So you buy this, and we'll get to what credit qualification is. But this was really on my mind today. These kids are buying, I'm going to buy 50 shares of NVIDIA, the hot stock, right? AI stock. Well, 50 shares of NVIDIA costs you $5,000 if you buy it at $100 a share. Say it goes up to $120 a share. You have $6,000. What most young first-time buyers don't realize, if you buy a $300,000 house and you give us $5,000 at closing, 1% plus some closing costs, and that house appreciates at 5%. Your $5,000 12 months later is now turning $15,000, because 5% of $300,000 is $15,000. Everybody's so bent on, I want to be in the market. I want to be in the market. All the wealthy people in America, their first venture into gaining wealth and financial independence was first invested in real estate. So let's just kind of lay back a little on the Bitcoin, the stocks, and say, you know what? I have to have a roof over my head. And why do I want to pay my landlord's mortgage? That is the number one thing that we have to battle against with first-time buyers is if you're paying rent, you're paying someone's mortgage.
What if they don't have a high credit score? Can we talk a little bit about that? What you recommend?
Sure. So our ideal credit score is 620 and above. That's our ideal credit score. 620 to 699, easy peasy FHA loan, which is Federal Housing Administration. So the federal government backs it. The interest rate is actually lower than a conventional loan because the Federal Housing Administration backs it. Keyword federal. If you're below a 620, it's not the end of the world. I do loans all the way down to 580. I actually have done a loan at 550. Might require more down payment. But what everybody does is they're afraid to actually have someone look at their credit. And we do soft pulls because I own the mortgage company on top of being a loan officer that produces every day. And the credit pulls today cost me $110. I'm not trying to be cheap here, but I'm being honest with everybody. A soft pull cost me $20. So what's the difference between a soft pull and a hard pull? A soft pull doesn't affect your score. You don't even know that we pulled your credit. You won't even know. No one's going to know we pulled your credit. But it gives me the full story. And when we do a soft pull, maybe in our next segment, we'll do credit rescoring. I'll show you how we do it. We do a soft pull and say your score is a 616 and a 615. There's always a little plus next to that score. And I click a button that says, you know, Tony, if we tell Mrs. Smith to pay down her city card from $300 balance to a $100 balance, her score goes up 8 points, easy peasy, 620. The reason I'm focusing on the 620 though, Rhonda, is a lot of the down payment assistance programs require a 620 minimum credit score. And that's what no one wants to tell you in the beginning. Oh yeah, we got down payment assistance. All of a sudden you're like, oh, why do I need 20 grand of closing? Well, because you hit a 615. Well, rescore them. It's easy. But credit is not hard to pop up when you're young because in our eyes, you have thin credit. You're young. You don't have 30 years with a city card, 30 years with a Shell gas card like I do. You have 16 months with a Discover card, 19 months with American Express. So every little blip is just, it's erratic, you know, it just goes one side to the other. So credit is easily fixed when you're young. It's actually a little harder when you're older. But when you're younger, you know, under 40 years old, you don't have this huge history of negative stuff. You just have your credit limits and your credit balances affect your score tremendously. We can pop you up quickly.
What if you are a part-time worker, but you've been working in a hotel casino for many years?
Absolutely. We can use the income. Part-time income is very simple. 2 years receiving part-time income, we take that income divided by 12 months. You know, if your W-2 says you made 40 grand part-time, now you have roughly 3,300 a month in income, right? And all of a sudden now you got part-time income from the hotel, maybe receiving Social Security or, you know, Social Security income or child support income. As long as there's 3 years continuation, we add that to the file. I can tell you a really quick story about no income, right?
Yes, we'd love to hear that.
My son decided to quit his job as a nurse at Christ Hospital in Chicago and just got like 4 years of that. He goes, Dad, I got to find a different career. So he went to be a nurse anesthetist. So he got accepted at Wake Forest University. He had no job. He was going to college and spending $60,000 a year on college to be in anesthesia. We went down there and looked at rentals. Rentals for a 1-bedroom, 1-bath was $1,500 in Winston-Salem, North Carolina, where Wake Forest University is. We found a condo for $125,000. Total payment with taxes like Las Vegas, the taxes were $900 a year. Total payment was like $900. I'm like, son, I'm just going to buy it with you. I'm going to put you first on the mortgage, even though you don't have a job, and I'll be a non-occupying co-borrower. So if you have part-time income or you have this minimal income and a parent knows that you have a side hustle with other income and you can make the payment, let's put your parent on as a non-occupying co-borrower. We'll get away with 3.5% down, just like I did with Nick. We put 3.5% down. He lived there for 5 years. And this is where I'm going to go back to my stock market comment. We bought that condo for $110,000. We sold it 5 years later for $215,000. So $5,000 investment turned into a $100,000 profit. You're not making it in the stock market all the time. And that's what I'm trying to say.
That's a fantastic example, because I know there will be people that will probably make comments on this video and argue back and forth about the stock market, but there's no question that real estate is an investment. And it's a solid long-term investment. So, okay, I have another question. I know you've been talking a lot about, sort of the young people and the college folks. Let's talk about their parents. Let's talk about the folks that are, retired and looking to move to Las Vegas. Maybe they have Social Security income. Maybe they have another home to sell from in another state. Can you talk about the types of loans and products that you have to get someone, from, say, either California or Chicago or Minnesota to Las Vegas?
Sure. And that's a really deep conversation that I will have with a borrower, because I have to know the whole story, because there's so many different products out there. And I'm just going to say it's not hard to do. Number one, we have the bridge loan. So you have your $300,000 Chicago property that's paid for. You're going to Vegas to buy $500,000. You're making $4,000 a month in Social Security and $2,000 in pension. So you got $6,000 in income. $6,000 is not supporting $700,000 in real estate. But there's programs out there where I can bridge that property is paid for, temporarily give you some money to buy the other house with the true down payment, and qualify you just on the payment, a $200,000 loan for a Vegas property, not a $600,000 or $500,000 loan. A lot of people are like, oh, I can't afford to do this because I don't have enough income to support the new house. And let's be honest, I'm 59 years old. There's no way in it, I don't want to swear, no way in HE doubles hockey sticks that I'm going to move in one day. I'm not going to close on my house in Chicago on Monday morning, then close on Vegas Monday afternoon and have all my crap out after living in it for 30 years. It's not going to work. So these bridge loans are awesome. The other thing that people with houses pay for don't realize is you could take a small HELOC out on your existing property, then rent it out. Because if I'm struggling with your income, say you only have $4,000 in income, right? Because you're retired and you want to buy this bigger house or more expensive house in Vegas, we can use the rental income from the new property and put it over, use that as an asset and offset the taxes, insurance, and everything with that. So now as we're doing and pull the money out to put money down on the other property. There's multiple ways of doing it. I had this borrower.
And by the way, I'm sorry to interrupt you, but when you're using acronyms like HELOC, not everybody knows what a HELOC is, and they're going to rewind and still not know. So can you describe what a HELOC is?
A home equity line of credit. It's basically saying my house is worth $300,000. I look it up on the AVM, or I look it up and it says it's worth $300,000. We give you a $150,000 line of credit against that property, and you can use that $150,000 to put down on your new property. It's called a home equity line of credit. Now here, because I've been in the business 28 years, I'm doing all of my kids' clients, which is or all my clients' children, which is funny. But now my clients have went to a whole nother level. Like when I was 35 and doing a 50-year-old person's loan, they are now 75. And they're like, Tony, my kids moved to this community. How do I get to be by my children, my grandchildren? And you and I talked about that one client earlier about a reverse mortgage. Everybody thinks, oh my gosh, reverse mortgages are the end of the world. Rhonda sells a house in North Las Vegas for $2.25. I go and I put a $250,000 reverse mortgage on the new property. You have no payments. And here, a lot of people think, oh, that's just a bunch of BS. Tony, reverse mortgages are bad. My mother-in-law and father-in-law, which I'm more than happy to have them on the show sometime with you, have had a reverse mortgage for 16 years. Do you know why? Because they retired. All the children moved to the far southern suburbs of Chicago, meaning my wife, her brothers, and et cetera. They couldn't afford to live in that community, but they had this house in the near south community suburbs. They sold that for $200,000. They put $125,000 on the townhome in 3 blocks from my house. So God bless my parents. They've been neighbors to me for 17 years. And I gave them $150,000 reverse mortgage on it. So now they got to live by my wife, who was their daughter, by my brother-in-law, who lived in the same subdivision as me, and the other brother-in-law who lived 4 miles away. And they got to be around all their grandkids. But when you're on Social Security and limited income, because not everybody has that great big pension anymore, you want to be around your children. You don't want to drive 17 miles. And trust me, my eyes are getting worse at 59. I can only imagine what your eyes are at 75. It sucks driving home at night. But my mother-in-law and father-in-law have been to every single one of my kids' baseball games, going through high school, through college, because they lived in the community. So we have solutions.
Let's talk about that, because when retired folks want to be near their family, that means they love their family, and that also means they're worried about their family's inheritance, right? They're like, well, but if I do a reverse mortgage, does that mean my kids won't inherit anything? Can you talk a little bit about that misconception?
Sure. The average rate on a reverse mortgage today is about 6.5%. The average appreciation on homes in America over the last 10 years is about 5.1%. So the kids are going to lose 2% a year on that so-called inheritance, because the house is appreciating, and yes, the mortgage balance is increasing, but it's only increasing really about 2% a year because your house is appreciating 5% a year. So my mother-in-law and father-in-law are now 85 and 86. And my father-in-law has diabetes, heart condition. It's not the greatest scenario for him. If he passes and my mother-in-law still lives for another 5 years, she doesn't have to make a mortgage payment. When it's all said and done, and I hate talking about death, but when they're all done, and if they're gone, you have 6 months to dispose of the property as the estate. So let's say they owe 190, or excuse me, in this case, they owe about 210. Their townhome is worth about 400 right now. Okay. So there's 190,000 equity. The estate has 6 months to dispose of the property. The family has that equity. So when they go to sell and there's 180,000 at the closing table, the family gets it. Everybody thinks, oh, the reverse mortgage company gets all the money. No, it's a regular
That's
mortgage.
the misconception. That is exactly the misconception.
Right. I mean, if you owe $150,000 on your house, you sell it for $300,000, you go to the title company at closing, you get a check for $150,000, the net proceeds. It's the same thing. Everybody thinks, oh no, the government takes it up. Wrong. There's even one step further, Rhonda, that no one understands. And I've done this 4 times in the last 2 years. We had a couple people that owed more than what the reverse mortgage, because they lived to the 95, right? So the estate owed more. So the estate can do 2 things. They can say, that's your property, reverse mortgage company, we're done, and not do anything. Or they can say, you know what? My son, who would be the grandson, wants to buy, grandma's house, and the reverse mortgage company is clear and written into the contract. They can buy it for 10% less than current appraised value. So in simple English for our first-time buyers or for our elderly people, if I owed $400,000 on a reverse mortgage, so I lived till I was 97 years old, and my house was only worth $300,000, my kids or my grandkids could buy it for $270,000, and no one would owe the extra money. Does that make sense to you guys?
Mm-hmm. So I think you said, in order to clean up your credit, when you and I talked before, you talked about not having repossessed cars, foreclosures, things like that lower credit scores. Can you talk about things that you would just recommend, people stay away from when they want to buy a home?
Yeah. So a lot of people, especially young people, they see this beautiful car, and because they can't afford a brand new one, they buy a used one. All of a sudden it blows up 3, 6, 12 months later. And they call the dealership, they brought it from the dealership, oh, bring it in, we'll just give it back and get you a new one. So what the dealer's game is on that is they're going to have you return the car to them. They're going to give you financing on a new car. And then 3 months later, you're going to get a notice of default on the first car. They're not going to give you the money for it. They're just going to tell you, they're basically telling you, don't make any more payments on it. Let them repo it. And the young people don't realize it. They think, I brought it back. It was voluntary. There's no voluntary repossession. Either you're behind on the payments, the car blew up, and now it even sucks worse is the insurance companies aren't doing replacement values on cars. So if you buy a $50,000, 2-year-old 5 Series BMW and you total it out a year later and you owe $40,000 on it, and the insurance company says, well, it's only worth 30, now you got a $10,000 default on your car because you owe 10 grand. So those are considered repossessions. They're very difficult for us to get around. Once a repossession is there, you have a couple choices. I would suggest calling the company and saying, yes, I owe you 10 grand. We told them my car didn't have the proper insurance. I owe you 10 grand. I would recommend if you had a car that you owed too much on and you gave it back or you totaled it out, correct? And you're a negative on it. Call the creditor. Don't just ignore it. If you owe someone 10 grand and you can't pay them the $499 a month the old payment was, call them and say, look, set me up on 10 years at $100 a month. Because now it's not a repossession. It's just it's like a big credit card bill or a student loan, a 10-year deal. Most people just ignore like, oh, I got a new car. I don't need to deal with these guys anymore. When you ignore challenges with your credit, you are going to create bigger obstacles for you long term. And these things hang out. Repos.
I've heard the expression, bad news doesn't get better with age. And I think that that's a perfect example. So can we wrap it up with talking about medical debt?
Medical debt. And
some people are worried like, oh my gosh, I have student loan debt, I have medical debt, I'm never going to qualify for a house. So they just don't even try. Tell me a little bit about that.
All right. So, I have children. I talked about my kids going to secondary school too. So my kids all had $120,000 in student loan debt. We're going to start there first. I'm old school Italian. I'm like, well, you're going to move back your blank to the house until you pay off your student loans. That doesn't always work when they're married. And I don't really want them there anymore at that point. But either way, student loan debt, you got two choices, right? You can put it in forbearance. And I know the government's screwing around with that. That's fine. If you owed $100,000 in student loans, we're going to charge $500 a month against your debt ratio, 0.5%. But here's a better solution. The government's reopening all the student loan stuff up now. Income-based repayment plans, IBR, income-based repayment plans. If you owe $100,000 in student loans and you make 90 grand a year, your IBR will probably be $90 a month. Get on that, because now you're never in default. You're going to pay the government $90 a month for the next 30 years. Who cares? It's better than getting all the late notices, the late payments, and 90 days late on your credit, destroying your credit. You're afraid to answer your phone because it's the government calling you. Pay them a little something. That's number one. The medical debt, same thing. I was uninsured when I was 25 years old and had my second child. I owed the hospital like $9,000. You can go and settle after like 90 days of giving them $10 a month. They cannot report you as in default if you give them $10 a month.
Is that still true today? Because the hospitals will tell you that's not true.
If they cash your check, you can then dispute it and say, I paid them. I'm sorry, a lot of people don't have checkbooks anymore, but you get a check and you can prove you paid, and the credit agencies will say, yes, they accepted your payment, so they're accepting your payment plan.
Okay.
You've got to be like.
Thanks again, Tony, for being on today's episode. Next time, we will talk about down payment assistance. I know you love to use your favorite acronyms of DPA. People don't know what DPAs and HELOCs are. So we're excited to hear about down payment assistance programs in our next episode. In the meantime, the very first step, just to kind of close out about eating the elephant one bite at a time, just have a mortgage lender do a soft credit check and give you an idea of what you qualify for. Talk about what your monthly payment would be, and have a trusted realtor like me run a search and just start getting those emails, maybe weekly, maybe monthly, to get an idea of the houses that you can get for the what you've been approved for, and maybe run around Las Vegas. I personally love running around Las Vegas and looking at homes. So I would love to go out and check out different homes and areas and see what's close to what you enjoy. You like shopping? We have everything in Las Vegas. So if you found this video helpful, give it a like, hit subscribe, and leave your comments and the questions below. I really look forward to the arguments we're going to have about the stock market versus real estate. That's going to be a lot of fun. If you're ready to take the next step, just reach out. And thanks, everyone. Have a great day.
Thanks, everyone. Have a great day.